Hi everyone, it's Sean from STK Markets here. Listen, we're doing this confession session. We've currently got Nutritional Growth with us today. We put a little bit of money into that recently, and it's gone heavily against us. What we are pleased to see, the company has changed its direction in terms of senior management, because clearly it wasn't working. We've got Steve Turner here today. He's got a huge wealth of experience operating in this sector, taking micro caps or into small caps and medium caps, worked out some very good exits, and is actually based in the USA where their main business was. The previous CEO was based in Israel, didn't get to the US that much, and didn't really have a huge marketing background for what I've been led to believe. But Steve Turner, hopefully this story is going to turn around, and it looks like there is good growth at Walmart. It does look like things are turning. And it looks like they've started to pull massively back on costs. They've got that number really low, which they have to get in revenue, and they're almost there at break even. But Steve, thanks for coming today, mate. It's going to be a tough call, but thank you for turning up and facing our investors.
Thank you, Sean. Welcome to be here.
Well, there's a couple of things which are on everyone's lips, and I know confidentiality agreements are very painful to investors, but the key message or the key reason we went into this deal was that Nutritional Growth Solutions was expanding its footprint into the US with that huge store, Walmart. It's the biggest retailer in America. They've got over 4,000 stores. It is the biggest one there. The Walmart family is worth gazillions. So they obviously know what they're doing in retail. And to get in the stores, I know with my experience with Woolworths executives, it's a hard process to get in. So you got in last October. We've really wanted to see what the financials are. We're all going to be looking forward to seeing this quarterly to see that revenue growth, because hopefully you can deduce what's happened there. But can you just give us a rundown of what's happened at Walmart, and should we continue to hold these stores, and have you got this turnaround in hand?
Yeah, so let's back up specifically on the Walmart play. One of the things I was brought on board a little over a year ago specifically to help execute our retail strategy in the US. That's what my background's been for north of 20 some odd years in the US. And I've taken everything from small emerging technology plays to established portfolios of products and help continue to grow their sales in the US. Sales and getting penetration with retailers is really all relationship based. So I've been calling in some cases on buyers that have been at the desk for 27 years. And with Walmart, the difference is they rotate through their merchant teams, but at the end of the day, again, it's essentially making sure you know who to talk to, have a product that gives them some level of interest that they want to put on shelf, and then go down that path. So what attracted me to this brand, to this company in the first place when I came on board a little over a year ago, was there was a product that had true real science behind it, had a really strong intellectual property portfolio. And from a business perspective, that's important because it's something that you can defend and protect. The last thing that is fun to work on is if you have a dietary supplement that you don't have really the ability to defend and protect, because then every effort you do to build your market share, everybody else can capitalize on, and potentially you lose your spot, and it's all price-driven market. So with the Healthy Heights portfolio, we had basically a really sweet opportunity to be able to build on that. So then when I looked at it, of course, the previous management, the previous leadership that I was replacing for North America, they weren't the retail play. And so it was important to basically put people on the leadership team that knew the process and understand how to play the game. So that's really why I was brought on board. The most important thing that we did over this last year, of course, was securing Walmart. And one of the things that was pretty exciting in the 20 some odd years that I've been working with consumer products in the US, I've always worked with companies that sourced, manufactured, or did the bulk of their production outside of the US. So, for example, my last company that I was working with was Pharmacare, which is a Warriortown, Sydney-based business, privately held company that competes with Blackmores. And I was working with the US or the Americas team. We had Sambucol was the largest horse in our stable as far as brands within our portfolio. And the challenge that we had with that brand is we basically lit fire on the elderberry market in the immunity space in dietary supplements in the US, and everybody just gobbled to it. So now if you were to look at that category, fast forward 5 or 6 years, there's probably 150 some odd different products that just basically cloud that space. And it was really built on the fact that it was hard to essentially protect and defend. And so, again, with Walmart, we were invited to participate in their open call process, which was Sam Walton set aside $3.5 billion of his funds to be earmarked specifically to cultivate and foster U.S. businesses. And because we are a U.S. company that manufactured a product in the U.S., we qualified to participate. So this was a unique opportunity. 17,000 US companies applied. Only 1,000 of them were actually invited to attend. We were one of those 1,000. So as a small company, that was a pretty big deal. Of those 1,000 companies that participated in that 2-day event, we were one of 300 that was awarded business. I got back from that trip and was immediately asked to be put on TV because on the West Coast, we were one of 2 companies in North America on the West Coast that basically won business from Walmart. And so that's a big deal because we checked this box in Sam Walton's desire to basically be that US business, have a brand that's manufactured and assembled in US, and basically sort of earmark his ability to basically say, okay, now Walmart is this giant monolith, is cultivating US opportunities. So fast forward from that, we were able to basically gain distribution with 2 items in 408 stores in the US. And to give you an idea of the magnitude of what Walmart is, in 3,500 stores, they move 1/3 of all consumer product sales in the entire country. Contrast that to Walgreens Boots Alliance. They have 11,000 doors, and they only move about 18% of all consumer product volume. And so in a fraction of the physical footprint as far as number of stores, they move exponentially more product, generate more revenue. They did $600 billion in the US last year alone. And so 400 doors, although it sounds like a small number, is actually a big opportunity for us. And so what we needed to do was basically answer the opportunity that was awarded to demonstrate that we could speak to a Walmart consumer, which is typically a price-sensitive shopper, and that we could compete in the toddler feeding space where we're sitting on shelf next to brands that are half our price. So, of course, the biggest question is, could we sell off of the shelf at a rate that made Walmart excited so that they know that they could make money, because that's all that really matters. And that rate that they established was equivalent to 200 units of volume of our product in a given week for a given flavor, because that's equivalent to half of a unit in the total number of stores that we were awarded. We've eclipsed that actually since October. Our average sales rate with consumers on our product currently is north of that, 2.5 times basically what that initial expectation was. So when you look at the most recent news that we put out just a week or so ago, where they awarded us an incremental number of doors, where we're going from 400 to 465 doors starting in May, that's an important milestone, because while the number may not be overwhelmingly huge, Walmart doesn't give you additional distribution if you're not performing. And so it's a good indication that while we weren't really even expecting it right now, because we just started in October, they're already giving us more doors. And they're giving us more doors because we're performing at a level where we're clearly making them money and, of course, making ourselves money. So the journey for us is going to be continuing to support our business through our marketing and advertising efforts to continue to draw footfall or shoppers into these stores so they buy our product. If we can continue to do that, which we've so far been able to demonstrate our ability to do that, then we will get more and more distribution, and we will also get the potential for more and more items to be put on shelf. So it's important to note that coming from our open call event that we participated in, we sat down with a merchant team, what was supposed to be a few-minute meeting, for over an hour. And the net result of that was we developed a product that met his particular wish list and needs for his department, so almost in a collaborative way. And that item is actually going into stores this fall. So we're sitting on a business right now that's already working with the largest retailer. We're already on shelf. I'm not trying to spin a story and tell you that we hope to get sales. That was the story a year ago. We already have 2 items on the shelf. We have a 3rd item coming this fall. We know because Walmart is also selling our entire portfolio in their online channel, which is different from what we do on Amazon. Walmart actually buys product from us, puts it on their walmart.com and sells it to consumers and fulfills it themselves. So they have direct visibility on what items are performing. It just so happens that the 2 products they have on shelf, there's a 3rd one in that family that's just a different flavor. We're selling chocolate and vanilla on shelf. We also have strawberry available. Our strawberry item online with Walmart is outperforming the chocolate and the vanilla. So there's a really good potential that I could tell you that by the end of this year, I might have 4 items in distribution at Walmart. And to give you perspective, I had 4 items of Sambucol at Walmart in their cough and cold aisle, which was a seasonally shopped aisle where most of our sales was 6 months out of a year. And I was generating $35 million factory back to corporate on those 4 SKUs. And that was an assortment where only 2 of them were at the same price point of what we're selling. The other 2 were less expensive. So it's really easy for me to tell you that there is a future for us 18, 24 months down the road, where if we can continue to build distribution, continue to show Walmart we deserve to be there, they will give us more and more doors as we continue to grow our business. And I want to get to 2,400, maybe 2,800 doors, and that's it. Because the balance of the C stores, that extra 1,000 extra stores, doesn't do much dollar volume in the eyes of when you look at Walmart's revenues. They generate roughly 80 to 90% of their revenues from 80% of their footprint. So that extra 1,000 stores, we don't really want to be in because that's chips and soda, and it's just not really going to be what we want to be. So over time, we're going to build a business that's going to be 4, maybe 5 items on shelf, and we'll continue to basically mine our life cycle so that we have the benefit of pipeline, which is going to be their infill purchases whenever a new item gets put on shelf. And we'll get pipeline every time we either pick up a new door, a new store. We'll get pipeline every time we add a new item. And of course, we'll continue to refine and adjust our portfolio specifically for Walmart so that we have the benefit of future pipeline ongoing from here until whenever we stop doing business with Walmart. And then Walmart, again, is important because for me, it represents a huge burden that's been lifted off of me, because now when I talk to other retailers, I already have the answer to the question, will you sell? Does the consumer care? Because we've been able to basically take worst case scenario and perform at a high level in a market that's really challenging. And I have now the ability to use my data and insights that I'm getting from the benefit of working with a retailer like Walmart to be able to peddle and leverage getting additional distribution with other retailers, because that's the whole point. We don't want to have all of our eggs in one basket. Historically, we've had basically the lion's share of our sales on Amazon. And when Amazon has an issue, sales get interrupted. Now, of course, we have Walmart leading the charge to help us build a business. And I want to take us to a point where when you look back in 18 to 24 months, 60, 70% of our top line revenues are coming from retail, from stores, because that's the reality of life, at least in North America. 25, maybe 30% of the commodity volume is moved online. The vast majority of it is still tactile. People want to touch and feel and shop. And so it's making sure that we have an item, again, that we can get off the shelf and also increase our distribution with Walmart and every other retailer that ultimately will come to the table for us because we have a product that consumers like.
One thing with the products that your consumers like we've seen the quarterly, we know there's been a cash burn last year. We were down about 4.1 million. When we last spoke, it was 7 million approximately was the magic number to break even. With the new restructure, you've shaved a lot of costs off that. You've brought that figure down low. What's that figure at the moment in Aussie dollars?
We're looking at 5.4 million Australian from a run rate standpoint to basically have enough top line revenues to sustain operations. And then
what was the figure last year?
It was north of that because we had roughly an incremental $700,000 to $1 million of extra costs that we were basically bolting on because we were attempting to build and get into China and some of the other APAC regions directly, as opposed to using one central location to get into those markets.
So what I can say to our investors is that you've virtually shaved off 2 million from your cost to get the company lean, mean, but you haven't sacrificed your growth. You've got your crown jewel sitting there. And right. What I saw last year was around 3 million Australian in revenue approximately. So you're looking at, we only need to make up 2 million, and Walmart only started in October. So if that's starting to kick off, and the key things here I've got to look at is that you started at 200 units, just say you started with 100 in October. Have you gone from 200 then to 300 each month? Are we seeing more and more units go through the same stores, or does it sort of plateau where you sort of leach up, then you go sideways? So we need those extra stores to get that continued growth. Have you worked out what it took a little while to get going, but now it's taken off? You're getting more stores, so that means you get more revenue. Amazon's 1.8 million in sales, and that's through the online version. You've actually got boots on the ground here. Do you think you could make, and you've got other revenue streams to get to that 3 million? Could Walmart in the short term get you across so you actually break even and getting to the point where you actually cash flow positive?
By the time we have placement, so when we look at the end of Q3, beginning of Q4, when we have our third SKU actually going in, we're going to have the benefit of that pipeline influx, which is going to translate to every door that we're awarded for business. They're going to want to buy enough inventory to hypothetically cover them for 2 to 3 months. And so we're going to get a larger cash infusion whenever we have that pipeline event happen. And that's going to happen at the end of the third quarter. No, that's September-ish for the new item that's going into the store. We do have the benefit of incremental business going into May as well. So we'll have a small pipeline for that, but that's going to be single digit hundreds of thousands of dollars of windfall. But when we have the third item going in, that's also the point at which there's a strong potential where we would be awarded more doors for our existing business as well. So that's the point at which we're, from a run rate, when you look at our sales expectations based on what we're doing now, our run rate from an annualized standpoint for what we're doing is significantly larger than what we need in order to break.
So I know we can't quote figures, but I'm going to get to the bottom of this. So I think you've given me the opportunity to. For an extra 10 stores, 50 stores, which is 10% of what you're doing at Walmart, you're talking hundreds of thousands. So if I step backwards there, we're over a million. So this could really change the way NGS moves forward as we keep growing through that rollout. I can actually quite see now how we can become cash flow positive and we can get there. And with your background and the way you've changed everything within the company, it appears that we're finally going in the right direction and moving forward in the right way.
And keep in mind, I'm not giving up. The company itself, we're not giving up on other market opportunities. We're just going to do them from our platform of strength. So I have the ability to test the APAC region, to test Japan, to test Europe and other markets from my production and from our operations in the US. So where we made the decision to try to build and enter from a more of a traditional cross-border exchange into China, we don't need to do that. So going forward, I have the ability to basically siphon off at a low risk product from my existing manufacturing operations in the US and do digital cross-border e-commerce that basically becomes truly incremental, because then it's just a function of test the market, see if we can get consumers to resonate, invest a small amount, low risk in inventory, low risk in marketing dollars, see if it works, do the test and learn as quickly as possible. If it fails, pull the plug, and I've only risked a few $1,000s as opposed to hundreds of thousands of dollars of infrastructure. But then if it works, we can just keep funneling it. And I'm winning because then my batches in the US actually increase. So my cost of goods goes down even more. So then I have more margin to play with as we continue to fuel the fire with what we're doing in North America. And so that's really the pivot. The change has basically been looking in, focusing specifically on what's working, what we're doing in North America, use that basically as our center pin, and focus on delivering what I started a year ago and continue to build our retail expansion with the brand.
So the major difference with you coming on as the CEO in February, like you've taken the reins through this turbulent time, are you confident that with your history of success, and you're not a one-hit wonder, you've done this many times in your 20-plus years career, you've successfully brought a product to market, gone through your Walmart sales, like you being able to pick up the phone and speak to the person there. Did they have that before? I mean, what's the major difference here? Have you cut out a lot of risk from the business, a lot of fat? Why is it different?
We didn't have that before. We had zero retail presence. We had zero ability really to deliver on the retail challenge. When I started, we were almost 100% e-commerce, completely digital. So the brand was launched on Amazon. All of our inroads and really all of our revenues that were being generated were purely online. There was no successful physical retail effort that was in place until I was brought on board. That was the whole reason that Laurent and the company brought me on board in the first place, was because they realized that the predecessor that was calling the shots on what we were trying to execute on. It just wasn't quite working, and they needed to bring somebody in that had that experience. And so what I brought to the plate again is being that startup, being that build architect that helps build OTC verticals or small emerging brands and takes us to that point where ultimately we have a business. And then it'll be time for me to bow out and you bring in somebody that's more of your evergreen strategy where you're optimizing and cultivating and sort of milking the cow that we've created that's probably 2 to 5 years down the road. So at the end of the day, that's sort of really what was lacking. And the change that we made, and really the board's emphasis on the change, was to basically say, okay, we need to make sure that we have somebody that understands and speaks the language and understands the retail play in order to basically be running this so that we're making the right moves in order to capitalize on the opportunity. But at the end of the day, the product itself hasn't changed. We still have a portfolio, a family of products that really gives us a great opportunity to capitalize on right now. There's a big gap in the market. So retailers are seeing that, and the consumers are obviously helping point that out by voting, by buying product. They're voting with their dollars.
So clearly the strategy is working with Walmart. It's just taking a little bit of time to get there. So it's slow and steady wins the race, but you're seeing the growth that could get to that top line revenue of 5.4, which, as I said, is only 2.4 above where we need to be. And we should be able to achieve that with what we're doing. Okay, Steve, you've given us a lot of information of how you're going to manage the turnaround and how things are going to change in the future. Your primary focus is Walmart, and that is growing. You're going to more stores. With these extra 10% of stores that you've got virtually, when will be the next looking to get some more stores so we can look forward to announcements like that coming out, which will obviously mean a lot more revenue for the company?
Sure. So Walmart and retail in general, they think in periods of 9 to 12 months at a minimum. And so typically they won't touch their sets more than one time a year. We were the lucky benefactor of them actually breaking their rules. So there's a May, which is the
just 1 second, sorry. So Nutritional Growth Solutions products, generally you're saying 9 to 12 months. You'd been there 3 months. So they generally wouldn't look at you for 12 months, but they broke their rules within 3 months and gave you more shelf space. Is that correct?
Right, because the way Walmart thinks, and again, we'll do a deep dive here. So Walmart, the category...
No, we don't need to do a deep dive. The answer is they broke the rules and gave Nutritional Growth Solutions more floor space because you guys were selling enough product to warrant it.
They broke the rules by basically giving us the opportunity in the first place by putting us in outside of the cycle. So we were awarded business in what they viewed as week 34, which was basically end of September. That is not when our category that we're in actually starts their modular. Their modular starts week 16, which is this coming May. So everything that we've been doing since October until May is all bonus time for us. The 1 year clock doesn't actually start until this coming May. And we were awarded business for 1 year with Walmart from that period. So what they broke the rules on is that they actually touched the category outside of when they would normally do it one time a year. Normally, they're only looking at brands and only adjusting their modular and basically building their business in week 16 every year for this department, which is coming up. The first week of the year for Walmart starts February 1st because that's how they think. They're a 52-week cycle. So we were basically awarded a bonus opportunity because of some market dynamics with Abbott having challenges with products being out of stock. And a merchant that's had been following our brand for a year or two thought that it actually might perform, and she was willing to take a risk and put us in outside of the normal cycle and give us the opportunity to see if it would work. So our 1 year clock starts this coming May. What the recent award is for us was a surprise because we were told in December that everything looks great. We're going to basically maintain status quo, and we don't anticipate any changes. So we were going to stick with our 408 doors and demonstrate our ability to basically get sales, and then maybe have an opportunity where week 34, week 38 of this year represents another change for us to basically get additional stores and a significant step change. But we were awarded the incremental doors, taking us to 465 this coming May, which is our new footprint for the full year. And what realistically for me that I look at is, again, week 34 to week 38 of this year, which would be September, which just happens to be the same time that our new items getting placed in stores, is the next big inflection point where it's likely for us to get a significant change in stores. So not just the 65 additional doors. That's possibly where it's realistic for us to expect maybe 900 doors, doubling our footprint. We could get surprised. They could take us to 2,200 doors, but that's the point at which
so the main thing that we've got to focus on, it's just not the product increases that we're looking at selling store on store. And you have mentioned that there has been growth month on month on month on month. Are we still getting Are we still getting growth in March this month from October month on month?
Yeah, I can tell you right now that I have growth this week than I've over last week. So I have visibility. I see every single bottle, every item as it scans across a register. Walmart tabulates and calculates and captures all of that data, and I have the ability to get into
not only are we getting growth from the 50 stores, we're getting growth week on week on week with the product.
We're getting growth. Yeah, we're getting growth within our existing footprint. What I can tell you is if nothing changes and we don't get any more doors, we're still getting growth, and sales will continue to grow with the business that we're already managing. But it's foolish to think that they wouldn't give us more doors, because obviously now we're at a point where we've demonstrated the ability to unlock the Walmart shopper, and Walmart's going to view it as, okay, how many doors am I comfortable to give them so that I don't overwhelm their business and become all of their revenues, at the same time as I'm leaving money on the table because this product is working and the stores that they're not in are basically lost potential revenues. So they're going to continue to.
What I can say, the next thing, so we've got to tidy this up because we're running a bit over time, and I do want people to pay attention to these key points. With the growth that we're having from the stores that we've got now and the 10 that are coming on, would by September you would think you'd be in a position to be cash flow positive?
Yeah, absolutely.
That's all you need to say. And I said by September, we'd potentially by June.
Probably even earlier. Yeah, earlier than that. So, I mean, realistically, when you look at what I've got as a marching order expectations that I'd set specifically for us internally, yeah, absolutely.
We're actually
I will generate as much revenues on 2 items in the footprint that we have with Walmart than I do for my entire portfolio online.
That gets us more of a cash flow positive. Okay, listen, Steve, you have reassured me. I put in a lot of money. I've bought more shares on market, and this is for my own account. It's been one of my worst performing shares, but it does sound like the turnaround story's there. We have tried to get some numbers out of you, and you've inadvertently given us a bit of an idea where it's going, which I think this will make a lot of people feel a little bit happier. I think we'll definitely hold my shares. I want to see how this turnaround goes. I wish you the best of luck.
Thank you.
But I was quite tough on you before we did the interview, but I'm feeling a lot better after having had this conversation. And I can see some light at the end of the tunnel. So please don't lose track of Walmart. Focus on that. We'll be looking at the quarterly really, really detailedly. So please put as much colour in as what's happening there, because the market will read that. Not everyone will see this video. But keep doing what you're doing, and let's keep in touch. After the quarterly's released, we'll do another video there to update people. So we're keeping on track of what we're doing. But good luck. And let's speak soon.
Absolutely. Appreciate it. Thank you for your time.
Thanks, mate.